Morning, everyone. We're welcoming Hamish back again for our weekly chat. We look forward to having some more insights into what's going on and some explanation of some of the things that we choose to do through Hamish for you. So welcome aboard, Hamish, again, and good morning, Jay and Ben.
Thanks, BB. So we were just talking off air, Hamish, and obviously a bit self-interested here as well because I have this holding myself, but in a couple of recent client reviews we've been talking about the removal of the WAM Leaders holding. Maybe if you can just give some context on why you think it's appropriate for us to reduce our holding there and maybe look at other alternatives.
Yeah, for sure. Thanks, guys. So just at a very high level, with these listed investment companies, the key characteristics that we're looking for are often an attractive fee structure would be one thing. And in addition to that, if the fee structure is not particularly attractive, then we want the underlying investments to be different to what the rest of the portfolio would otherwise be. So if we look at WAM Leaders, so I think WAM is a solid manager. They've had a good track record, but the underlying fee structure isn't particularly attractive. Now, if somebody didn't have any other blue chip Australian equity exposure in their portfolio, then WAM could be a good supplement to that because it's giving you good blue chip Australian equity exposure. But if you already have a portfolio of quality blue chip companies and then you have WAM Leaders sitting in there alongside that, to a certain extent, you're just doubling up on your exposure. And in addition to that, they're also charging, fairly chunky fees. If we contrast WAM Leaders with something like Future Generation, both the Australian and the global ones, which, we really love, the underlying portfolios within the Future Generations are far more diversified. They're investing in long short funds and small and mid cap companies. So that's one thing. And then the other thing is that the fee structure is much more attractive as well. All of the underlying managers waive all of their fees and just 1% of assets get donated to charities. So hopefully that sort of helps answer the question.
Hamish, just an extension of that. You, with a couple of clients, myself included, had recommended Hearts and Minds.
Yes, great. So, great example, right? So, to me, Hearts and Minds is something that's unique. So, Hearts and Minds is somewhat like Future Generation, in that it's a philanthropic thing. So, 1.5% of assets get donated to charity, so a little bit more than what Future Generation is. But how the portfolio is constructed is there's an annual conference called the Hearts and Minds Conference, where I've been to for the last few years. It's incredibly expensive. It's something like $15,000 for the ticket for the day, and there's about 15 odd fund managers that get up there and pitch their top stock ideas. So this listed investment company, Hearts and Minds, HM1 is the ticker, was constructed to essentially take all of those key stock picks and put that into a portfolio, and then that gets rotated out each year as the new stock picks come through. So it's higher conviction than what something like Future Generation is, because the portfolio is much more concentrated. But the underlying sort of, I guess, intellectual property that goes into that is huge. And it's only been going for now, I think it's about 1.5 years. But to date, the performance has been phenomenal.
Yeah, it's been exceptional. Yeah, it's but certainly been a standout from your recommendations. It's been great. Now, maybe off on another tangent, Ben, you had a question for Hamish.
Yeah, and another one, a name that, whenever we see a new name jump into the mix, it always sort of sparks probably my interest and everyone's interest, and always the client interest. So I saw Ramsay Health Care sort of filtering through into a couple of portfolios, which I personally have sort of kept an eye on it for a while myself, but seeing it come into that mix is probably a good time for us to talk about it and see why it's sort of now on the radar for the clients.
Yeah, absolutely. So, yes, so we've started adding that into portfolios. Just to start from the top, obviously, what we're trying to do is own quality businesses that we feel we can own for a very long period of time. And when you think about Ramsay, so Ramsay is the largest private hospital operator in Australia. They also have hospitals in Europe as well. But obviously, this is an essential service. Ramsay has delivered, from a long-term perspective, it's been an exceptionally well-managed business that's delivered very attractive returns to shareholders. So, you know, we think that it ticks all of those boxes from that perspective. As we sit here today, they just did a capital raising a couple of weeks ago, and so that has essentially removed some of the balance sheet risk. The share price has come down because of that, and so we feel that that gives us an opportunity to buy into, you know, what we feel should be a very long-term hold at a more reasonable price now.
And from an income stream point of view, I think that their dividends probably started to grow in the last couple of years. Is that something that will? I think it's only maybe 2.5% or something at the moment. Is it?
That's exactly right. So it hasn't been the best yielder. I mean, but the dividend has grown quite strongly over time. So so consensus forecasts at the moment. Ramsay. Yeah, it'll be about 2.5%. And that's sort of tended to grow at sort of 5% plus. So yeah, it's not the best yielder, but it's a decent yield with reasonable growth coming through.
Yeah, perfect.
It's just a follow on. We have touched on this in some of our previous discussions. It has come up in discussion with a number of my clients in the last few days. Again, probably sort of some statements that you can elaborate on or lead us on. The banks in particular, with the reduction in dividends and the likely return for them, and where the banks still sit, in your view, as part of our portfolio, and you know, sort of on a ranking order. You know, again, it'll change from month to month, day to day, I guess. The dividend issue with the banks and how we fit them in, and how much of our portfolio do you think we should still be keeping exposed to especially the big four in Australia?
Yeah, it's a really important.
And what other options what other options are there, which I know I've got one of them, so you can perhaps elaborate on that too, if you would.
Yeah, for sure. So the starting point would be the Australian banks represent about a third of the Australian market. So when people look at the All Ordinaries or something like that, about a third of that is the Australian banks. So it's a very big component of the index. How we think about the banks is that they're good businesses. You know, they have strong market positions, but generally we don't love them enough to justify a third of a portfolio in the banks. Now, some people will have that if they really like the banks and they really want the income, but our preference would be to see the banks more like kind of 10 to 15%, you know, maybe no more than 20% of the Australian equity component of the portfolio. That's generally how we think about it. So the answer is we like the banks, but we also, they're very leveraged businesses, and in tough economic climates like we're seeing, obviously they get affected. And so for that reason, we don't like to see too much exposure in the banks. To your question about the dividends though, you know, so I mean, the banks obviously have a lot of challenges going forward, but you could actually also argue that, you know, that's probably now fairly in the price as well. So what they're all obviously doing is cutting their dividends, and so dividends now will be more sustainable and will grow from this low base. So if we just quickly go through them, so say Westpac in 2018 paid a dividend of $1.88. This year the dividend will only be about 50 cents. But then it's forecast next year to go back to $1.05 on average when you look at all of the consensus. So I would say that you almost don't look at this year's dividend. And so based on that dividend forecast of $1.05 for next year. That's about a 10% grossed up yield.
On the current price.
On the current price, exactly.
Yeah.
If we looked at ANZ, it'll be a fairly similar story. So ANZ paid $1.60 in last year. It's forecast to pay about 46 cents this year. Next year, it's forecast to be $1.03. So at $1.03, it's just under a 10% grossed up dividend yield. So, and you know, the banks, if you were to ask me what I think a likely return is for the banks going forward over the longer term, I would think that somewhere around that 10% kind of return would be a realistic expectation, you know, from these sort of levels.
So still an important part of the portfolio, albeit not excessive. Yeah. And the big four obviously are the obvious ones. You've started to add a couple of other bank investments in.
Yeah.
I mentioned that, like Macquarie as an example. Macquarie
yes.
Bank. I've got.
Yeah.
So.
Yeah, for sure. So Macquarie, a bit like Ramsay, this is another one that we'll be starting to put into portfolios. So Macquarie's been a phenomenally well-managed business over the years. It's generated phenomenal returns to shareholders. It's, you know, the big four banks are primarily focused on mortgages. You know, that's a big component of their business. Whereas Macquarie is more an investment bank, so it's a lot more diversified in terms of what it does. We've seen the share price fall from about 150. It fell down to about 80. It's recovered to a little over $100 now. They came out with an update the other day that sort of reassured the market. If we look at what happened in the GFC, Macquarie was able to opportunistically use that volatility to really set themselves up for future growth going forward. And I think, you know, given management's track record, I think that's reasonable as well. And so just quickly on the numbers there, Macquarie is now on consensus forecasts. Dividend yield for this year would be about 4.3% fully franked, which would grow to about 5.5% for next year.
So is that probably the one thing with Macquarie, probably in past years, is the dividend hasn't probably been at the same level as the other banks have probably reinvested? Is that the...
That's exactly right. So it's generated more growth and a slightly lower dividend yield. And obviously you can see that today. So thinking about next year's dividend, it's probably about 2% fully franked less than the others. But you know, I think it's reasonable to expect that would be more than made up in growth over time as well.
It could be very complementary because it's a little different. It's not the same as our big four. So it's a good complement to our portfolios if you see it's the right thing to buy at any moment in time.
100%, Peter. You know, rather than having, you know, 2 or 3 or 4 of the big four banks, you know, it would be better to only have 1 or 2 of those with a Macquarie Bank, which gives you a lot more diversification.
Excellent. Thank you.
Good. Well, guys, we better wrap things up. We've got another Zoom in about 3 minutes. So thanks again, Hamish. I was thinking you might be feeling a bit uncomfortable at home, you know, without us there. So I did.
Yes.
I don't know whether you've been down to Bondi since they've started to ease restrictions. Have you got in the water yet?
Yeah, no, I've been doing plenty of that. So the water's still a bit warm up here. It starts to get cold in probably in sort of June. So we're making the most of it at the moment.
No, very good. Very good.
Keeping our social distancing though.
Yeah.
All right.
All right. Well, thanks again, everyone. And we will see you again next week, same time, same channel. Thanks again.
Cheers.
Have a great day, Hamish. Thanks, mate. Bye-bye.
Cheers.
See ya.